Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Greenbrier Companies Inc. quarterly report. The Greenbrier Companies Inc. offers a diverse range of businesses and services to the railroad industry. At its core, the company designs, manufactures, and markets railroad freight car equipment for clients across North America, Europe, and South America. In terms of manufacturing, the Greenbrier Companies produces a wide variety of railcars, including covered hopper cars, gondolas, open-top hoppers, boxcars, center partition cars, tank cars, and intermodal railcars. Additionally, the company offers sustainable conversions, reconditions wheels and axles, and provides new axle machining and finishing services. The company's leasing and management services segment is equally impressive, offering operating leases and per diem leases for a fleet of approximately 17,000 railcars. This segment also provides management services, including railcar maintenance management, accounting services, fleet management and logistics, administration and railcar remarketing to clients such as railroads, shippers, carriers, institutional investors, and other leasing companies. Overall, the Greenbrier Company's diverse range of businesses and services makes it a leading provider in the railroad industry. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and complex. On one hand, manufacturing revenue has seen a significant decline due to a 32% drop in deliveries and a change in railcar manufacturing product mix, resulting in a $171.4 million decrease. Additionally, leasing and fleet management revenue has also decreased by $3.2 million, contributing to the overall decline. However, there are some positive drivers of revenue growth worth noting. The increase in rents associated with the growth of the lease fleet has contributed $4.2 million to revenue growth. Furthermore, improved lease rates have also contributed to revenue growth. While these factors suggest that there is potential for revenue growth, they do not appear to be sufficient to offset the decline caused by other factors. As a result, total revenue has decreased by $174.6 million, highlighting the need for further analysis and exploration of strategies to mitigate this decline. The company's net income and profit margins have undergone significant changes over the past period. Net income has decreased by 51.5% from $107.2 million to $51.4 million, resulting in a substantial decline in profitability. This decrease is attributed to various factors, including lower depreciation and amortization expenses, higher net gains on equipment disposition, and losses in the corporate segment. Profit margins have also taken a hit, with revenue margin decreasing from 18.1% to 10%. The manufacturing margin has been particularly affected, plummeting by 55.1% from 16.4% to 7.4%. On the other hand, leasing and fleet management margins have remained relatively stable at around 62.6%. The primary reason for this decline in net income and profit margins is the decrease in net earnings, which has been partially offset by an increase in working capital accounts. This suggests that while the company's cash flow may be improving, its bottom-line profitability remains a concern. To address these issues, the company must focus on improving its manufacturing efficiency, reducing costs, and enhancing revenue streams to restore its profit margins and net income. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The 6-month period ending February 28, 2026, saw the company produce $234.9 million in net cash provided by operating activities, a substantial increase from the previous year's figure of $28.5 million. This positive trend is further reinforced by other sections of the financial report, specifically pages 37 and 54, which also confirm that the company is generating positive operating cash flow. This suggests that the company's operations are becoming more efficient and profitable, enabling it to generate a significant amount of cash from its core activities. The company's debt level has seen a slight increase over the past period. Despite this, interest expenses have undergone significant changes. On one hand, interest expenses have decreased by 37.4% from $21.7 million to $13.7 million. This reduction in interest expenses is also reflected in the net decrease of interest and other expense, which has dropped by 20.9%. However, when considering total interest and foreign exchange expense, there is a more substantial decline of $15.9 million. The financial performance of the company's segments has shown varying results. In terms of strong performance, the leasing and fleet segment stood out. For the 3 months ended February 28, 2026, this segment generated $56.2 million in revenue, while for the 6-month period, it earned $148.8 million. Notably, these figures represent significant improvements over the previous year, with a decrease of -$24.6 million and -$53.6 million respectively. In contrast, the manufacturing segment struggled to report any meaningful data. Unfortunately, no information was available on its performance for either the 3-month or 6-month periods. Furthermore, it failed to generate any revenue or earnings during these timeframes, indicating significant challenges within this segment. Management is expressing optimism about the company's future performance, expecting to continue with current strategies and plans. The company has significant sales commitments through 2026, including $556 million in railcar sales and $90 million in fleet management obligations. Despite challenging macroeconomic conditions, management believes the company is well-positioned to execute its multi-year strategy. This strategy aims to increase recurring revenue, expand gross margin, and boost return on invested capital. Management also expects sufficient funds from operations to cover debt repayments, working capital needs, and planned capital expenditures over the next year. The company's operations and financial performance are at risk due to potential supply chain disruptions. A sustained economic downturn or ongoing supply chain issues could have a significant impact on the business, highlighting concerns about inventory buildup and the ability to meet customer demands. The threat of supply chain disruption is a pressing concern for the company, which may lead to decreased revenue and profitability. That concludes the financial summary for the Greenbrier Companies Inc. Feel free to comment below, and I will be happy to answer them when possible.